Earnings season is heating up. The market is expecting solid growth, but is it enough to come to grips with pricing in too many rate cuts? Our next guest thinks the next few trading days are huge in regarding to answering that question. For more insight on the markets in 2024, we're talking to GLOBALT Investments portfolio manager Keith Buchanan. Keith, it is good to see you. So we were just talking earnings, Keith. We're in peak earnings season now. We heard from the big banks. We got big tech on deck here. Keith, I'm just interested to get your take on this earnings season, what you've heard so far.
Absolutely, and thank you for having me. We start off the earnings season with the banks that left some to be desired, but we're fundamentalists at our shop. We think the equities still trade, and risk assets in general still trade on earnings and earnings potential. Coming out of the earnings recession of 2022 and 2023, we really expect that 12% growth that's expected over 2024 and 2025 to really shine through the equity prices at 18 times where we were trading last fall. Coming into this earnings season, we're at 21 times after the recent rally. So now the low-hanging fruit has been harvested, and we're looking at what could potentially push the market further. What unlock the potential for the market to see through that earnings potential and that growth that we're underway right now is that the Federal Reserve didn't push back on the dovishness, the anticipation of a dovish Fed throughout the course of 2024, and the Fed perhaps taking their foot off of the brake, let the market see back through to earnings of what's driving stocks on a fundamental basis. For that to continue, we feel like that dovishness continues needs to be pushed back. But the earnings growth and that profile is still intact. We think it's a real tailwind for markets at this point.
So, Keith, just to put a fine point on this. So, in other words, there was this narrative that the Fed was going to maybe cut 6 times this year. And a lot of strategists that we were talking to were saying they're not going to cut 6 times and they're not going to start in March. And the market's going to be disappointed when that realization hits. You're saying the realization was tempered, cushioned by the fact that earnings are turning out to be better than estimated?
Actually, the expectation has been tempered from 6 cuts to now 5 cuts. But still, let's remember, the dot plot put 3 cuts as the Fed's base case. So there's still a gap between 5 and 3 that has to, converge at some point. But how we look at the equity markets is the overhanging real negative sentiment was overwhelmingly because of inflation and the Federal Reserve's reaction mechanism. If that has started to go more so in the rearview mirror, that gives the marketplace more room to appreciate the earnings environment, which we feel like is extraordinarily buoyant coming out of the past 5 quarters.
So we're talking earnings, we're talking Fed, Keith. I'm also interested after the rally we've seen. How does valuation look to you here?
It looked a lot more attractive 3 months ago. 18 times, 22 times is not as attractive from a long-term historical perspective as 18 times is. But look, if the market is pricing in the growth of earnings, growth of cash flow, a lot of that depends on tech, which is why the next week is incredibly important to fulfill this optimism that's baked into bottom-up expectations for the S&P 500 to generate 12% earnings growth. So we're really excited about the potential for that market to really anticipate that in a more material way without the clouds of the Federal Reserve monetary policy kind of overhanging the marketplace.
And Keith, are you guys buyers of tech going into the earnings from those companies?
We've been long U.S. large cap growth, and that obviously is centered around tech in a very meaningful way for years now. It's been a great tailwind for our relative performance and absolute performance. Right now, we're holding steady with the exposure we have. We are really cognizant of the optimism that AI has baked into some of the names that have had the best performance. So we want to make sure that the way they get through earnings season is something that we're comfortable with on the other end. So we're not necessarily buyers hand over fist right now, but we still have that long exposure. We're overweight and we're comfortable with that.
And Keith, I'm interested within the banks. Where do you see opportunity in that sector?
Right. So coming out of last week, all the major banks reported. We've been positive on the banks, at least within the financial space for several months now. JP Morgan is the best of breed there. It didn't disappoint on a relative standpoint this past earnings season. Net interest income seems to be holding steady for JP Morgan, and we like the best of breed company going into what could be a trough year for net interest income. in a way that gives them some upside from an earnings contribution standpoint that we just haven't seen in several years. Now, does that unlock the valuation to continue to move higher? That's yet to be seen, but the stability of net interest income, as well as the environment of a normalization of the yield curve, we feel like gives that group and that name some positive momentum.
Keith, thanks so much for joining the show today. Appreciate your time and giving us some ideas of where to possibly commit capital. Thanks so much.
Thank you.